Hey everyone, welcome back to Corporate Decoder, the place where we crack open company reports and find the hidden stories. This time we're diving into Dana Incorporated's latest quarterly filing. And let me tell you, there is a lot going on, especially with a huge sale on the horizon and some interesting shifts in their business. Before we jump in, if you love getting the real scoop behind company finances and strategies, make sure you hit that subscribe button. And hey, we've got a fantastic Discord community brewing where you can chat with fellow corporate sleuths. The link is in the description below. Let's talk about the top line, the sales. For the 3 months ending the 30th of September, Dana brought in $1.917 million. That is a little more than they did last year, a jump of $20 million. Now, the 9-month total paints a slightly different picture, with sales at $5.633 million compared to $5.960 million last year. That is a drop of $327 million. So while the most recent quarter saw a slight improvement, the year-to-date numbers show they're selling less overall. It seems like there is a bit of a mixed bag when you look at just short-term versus the longer view. Now, what about the cost to make their stuff? For the 3 months, cost of sales went down by $24 million, which helped boost their profit margins. But for the 9-month period, cost of sales actually fell by a substantial $398 million. This significant drop in costs helped to improve their gross margin, which is a good sign that they are managing their expenses effectively. Speaking of gross margin, that number went up quite a bit. For the third quarter, it rose by $44 million, and as a percentage of sales, it was 8.7%, up from 6.4% last year. Over the 9 months, gross margin jumped by $71 million, reaching 7.5% of sales, an improvement from 5.9% in the prior year. This shows they are becoming more efficient in producing their goods. What about behind the scenes costs like salaries and office expenses? Selling, general and administrative expenses, or SG&A, went down nicely. In the third quarter, they spent $87 million, which is $19 million less than last year. For the 9-month period, they spent $291 million, a decrease of $37 million. This is likely due to cost-cutting measures and streamlining operations, which is a positive step for the company's bottom line. Now, this is a big one. Dana agreed to sell its off-highway business in June of 2025. This move is a strategic shift to focus on their main businesses. While the sale is expected to close in the fourth quarter of 2025, they had to account for it in their financials. In early 2024, they actually tried to sell part of their European hydraulics business, but that deal didn't go through. They recorded a loss of $26 million on that disposal group in 2024 because the criteria for selling it were no longer met. This shows they are trying to reshape the company, and these kinds of transactions can impact the reported numbers. Because they're planning to sell the off-highway business, its financial results are shown separately as discontinued operations. For the third quarter, this segment brought in $74 million, and for the 9 months, it was $164 million. This part of the business is still doing well, which is good to see before the sale. However, they also incurred $20 million in costs related to the sale of this business in the third quarter alone, which cuts into the reported profit from this segment. So, when you put it all together, what is left for the actual owners of Dana? For the third quarter, net income attributable to the parent company was $83 million. That's a huge jump from just $4 million in the same period last year. For the 9 months, it's $135 million, a big leap from $23 million last year. This signals a much healthier financial situation for the company. Let's look at where the sales are coming from geographically. In North America, sales for the quarter increased by $70 million. Europe saw a dip of $5 million. South America was down $11 million, and Asia Pacific decreased by $34 million. So, it is a story of North America carrying the sales growth, while other regions are facing challenges. The cost of sales in the third quarter actually went down by $24 million. This, coupled with better pricing and cost management, led to a significant increase in gross margin. The gross margin as a percentage of sales improved from 6.4% to 8.7% for the quarter. That is a solid move in the right direction, showing better efficiency in production and sales. Scroll selling, general and administrative expenses, SG&AP, their SG and costs, also dropped by $19 million compared to last year's third quarter. This is a direct result of those cost reduction initiatives they've been talking about, which is great news for profitability. The year-to-date numbers also show a significant decrease in SG&A, indicating a sustained effort to control overhead. This category is a bit of a mixed bag. It includes things like pension costs, foreign currency effects, and strategic transaction expenses. For the third quarter, it was an expense of $20 million, a pretty big jump from the $6 million expense last year. This is mainly due to higher strategic transaction expenses and foreign exchange losses, which are impacting the bottom line. Companies often use measures like adjusted EBITDA to show their operating performance. For Dana, adjusted EBITDA for the third quarter was $162 million, a nice increase from $111 million last year. For the 9-month period, it was $402 million, up from $311 million a year ago. This shows their core business operations are improving. Now, let's talk about cash flow. Adjusted free cash flow for the third quarter was $101 million. That's a big jump from a negative $8 million last year. For the 9-month period, it was a negative $7 million, which is an improvement from negative $72 million last year. This indicates they are closer to generating positive cash flow from their operations, which is crucial for long-term financial health. Looking at liquidity, they have $414 million in cash and cash equivalents. Plus, they have an additional $765 million available through their revolving credit facility. That gives them a total liquidity of $179 million. This means they have plenty of cash on hand to meet their immediate needs and debt obligations. Delving deeper into the sales figures, the overall picture for the 9 months shows a decrease of $327 million. A significant chunk of this decrease comes from North America, which saw organic sales drop by $220 million. Europe also contributed to the decline with a $55 million decrease after accounting for currency effects. This shows that while North America is still their largest market, it is facing some headwinds. For the 9-month period, the cost of sales decreased by a substantial $398 million. This helped drive up the gross margin to 7.5%, a significant improvement from 5.9% last year. This gain is attributed to cost reduction initiatives, material cost savings, and operational efficiencies. SG&A expenses also dropped by $37 million year-over-year for the 9-month period. This reinforces the effectiveness of their cost cutting strategies, freeing up more resources for other areas of the business. The off-highway business, even though it is up for sale, contributed $164 million in net income for the 9 months. However, divestiture costs for this business have already reached $54 million a year. To date, this illustrates the significant expenses associated with major strategic shifts. Let's check out the light vehicle segment. Sales for the third quarter were up slightly, and segment EBITDA increased significantly. For the 9-month period, sales were down, but segment EBITDA margin improved. This suggests they are becoming more profitable on each dollar of sales in this segment, even with lower overall volume. In the commercial vehicle segment, sales were down both for the quarter and year. To date, segment EBITDA also took a hit in the third quarter, but it saw an increase year-over-year for the 9-month period. This segment seems to be facing more pressure from market condition, but they are managing to improve profitability within the segment. Dana has also been actively buying back its own stock. In the third quarter of 2025, they purchased over 9 million shares as part of their announced program. This is a way to return value to shareholders and can also signal management's confidence in the company's future. This is probably the most significant event for Dana right now. The planned sale of the off-highway business is expected to bring in a substantial amount of cash. The company plans to use this money to pay down debt and return capital to shareholders. This move signals a major strategic pivot towards their core on-highway markets. Looking at the buyback details, it seems like they've been steadily purchasing shares throughout the third quarter, with the average price paid per share fluctuating. The remaining value available under the program gives them room to continue these repurchases. Now, let's talk about what this all means for Dana. On one hand, the company is taking strong steps to streamline its operations and focus on its core business. The improved margins and reduced SG&A expenses are positive indicators of better operational efficiency. The planned divestiture of the off-highway business, if completed successfully, should significantly strengthen their balance sheet and provide capital for growth and shareholder returns. However, there are definitely risks. The overall sales decrease for the 9-month period, driven by weaker global markets in some regions, especially for heavy trucks, is a concern. The company's reliance on the automotive industry means they are susceptible to economic downturns and shifts in consumer demand. Like the slower adoption of electric vehicles, the strategic transaction expenses related to the sale and other initiatives are also impacting their reported income. From a Warren Buffett perspective, I'd be looking at how well they're managing their core business and how prudent they are with these strategic shifts. The improved operational efficiency and focus on core markets are good. The sale of the off-highway business is a bold move that could pay off big if executed well, but it also carries execution risk. In conclusion, Dana is navigating a period of significant transformation. They are making smart moves to improve profitability and focus their strategy. While there are market headwinds and execution risks with the divestiture, the company appears to be heading in a more strategically sound direction. The key will be how effectively they integrate their remaining operations and manage the cash generated from the sale. Alright? That is our deep dive into Dyna Incorporated's latest filing. What are your thoughts on their strategy and these financial results? Let me know in the comments below. If you found this analysis valuable, please give this video a thumbs up because it really helps us out. And of course, subscribe for more corporate breakdowns. And don't forget to join our Discord community through the link in the description for more in-depth discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.